But you're not recording it, right? It's recording now.
No.
All right, welcome to everyone to the webinar, Trialogue webinar, sponsored by BanQu, focusing on the road to integrate and mature ESG metrics. The session is running from 10:30 until 12 o'clock today, with a brief welcome and introduction by Trialogue, followed by a brief overview of the challenges and opportunities regarding the integration and maturation of ESG metrics in organizations, which I will be tackling. And I am Matthew Lecourdeux. I'm the head of ESG and Integrated Thinking Advisory at Trialogue. And with me, we've got a range of esteemed panelists who I'll be introducing shortly. The session will run as such. We will be having each panelist will introduce their topic and provide some high-level insights on their approach and their learnings and their outlook. As moderator, I will then be asking a couple of high-level questions for the panelists to answer. And then we will be opening the questions to the floor. And you're able to ask questions starting now using the Q&A function. And please just may remind you on Zoom, there's a chat function and there is a Q&A function. Please, when asking your questions to the panelists, you may direct it to all panelists or to a specific panelist, and you may use the Q&A function to write your question. I will then be using those questions to ask the panelists to answer on that. There are also going to be a few poll questions that will be coming through that we will share the results as we proceed. The session is being recorded and will be distributed with a write-up and published on our websites and distributed via email. All right, so let us begin. The panelists today are really, from my perspective, are highly esteemed internationally. And we are privileged to have Dr. Ndidi Edozien, who joins us in her capacity as the member of the International Sustainability Standards Board, ISSB, which is part of the IFRS Foundation. And many attendees on the call today would have heard of the work that's happening with IFRS Foundation around sustainability. But Dr. Ndidi is a renowned business leader, entrepreneur, and advocate for sustainable development and gender equality. She hails from Nigeria and has made significant contributions to various sectors, including finance, technology, and social impact. Dr. Ndidi founded the Growing Businesses Foundation in 1999, which played a crucial role in assisting corporations like Unilever, Coca-Cola, Diageo, MTN, Mobil, and Citi in implementing scalable, sustainable initiatives at the base of the pyramid. From 2017 to 2020, Dr. Ndidi served as the Group Chief Sustainability and Governance Officer at Dangote Industries, where she integrated sustainability thinking, actions, and reporting throughout the organization. Ashish Gadnis is the co-founder of BanQu, which is a groundbreaking financial technology company found with a profound social cause. And Ashish, as I mentioned earlier, is joining us from Texas. It's 3:30 a.m. in the morning. So thank you so much for waking up so early. BanQu is revolutionizing the way we address poverty by leveraging blockchain technology to provide supply chain and economic identity solutions for individuals living in extreme poverty. Through their innovative platform, BanQu connects the unbankable to secure portable digital economic identity using nothing more than a cell phone app. The transformative technology opens doors to the global economy, empowering individuals worldwide and restoring dignity through identity. And Ashish's journey is deeply rooted in personal experiences. Having grown up in poverty in Bombay, he intimately understands the struggles faced by those marginalized communities. His remarkable career as a serial entrepreneur, building successful technology startups and delivering global mobile solutions, has propelled him towards his ultimate mission with BanQu. And then finally, Shoal Harding is the manager at Impact Catalyst, a South African initiative founded by Anglo-American, Exaro, the Center for Scientific and Industrial Research, or known as CSIR, and the World Vision South Africa, to create mechanisms that drive large-scale socioeconomic development initiatives through public-private partnerships. As an employee of CSIR since 2008, Shoal was instrumental in establishing the Impact Catalyst. Lead programs of the Impact Catalyst are implemented in areas such as agriculture and agro-processing, manufacturing, education, and community health, areas where technologies and innovation can be used to optimize economic activity and see to inclusivity in supply chains, bringing jobs and new skills. All right, so before we move on to hearing from our panelists, I'd just like to provide a brief overview of the topic from Trialogue's perspective. So for for many people on this call, ESG is coming to a pressure point, and there's a huge focus on climate change. This survey by Deloitte, with the graphic on the right, was done on 2,000 senior executives, and shows how different stakeholders are putting pressure on executives to focus on climate change. So as you can see there, from board members, regulators, consumers, shareholders, those are very high percentages of stakeholders who are asking executives to really take action on climate change. So that's the first point. Second point, ESG investments are set to outpace the industry as a whole by 2026. And there's a rising bar for ESG expectations and sustainability expectations, including improved integration of material issues, management of those key issues, and governance and reporting. Importantly, companies can't leave ESG and sustainability to the marketing department, as greenwashing poses reputational risks, and customers are expecting ESG-themed products now. An example of the pressure on quality is that a number of European ETFs with AAA ESG ratings from MSCI will now be decreased significantly as the criteria for ESG compliant funds tightens amid pressure from regulators. And that's going to be happening more and more. An issue that many investors and raters and rankers and others battle with is a lack of quality ESG data. And that's especially so on the environmental and social side. The graphic on the right, the turquoise bars is basically showing bad scores of data. And that's on the environmental score and the social score. And the various bars across are about 15 different types of industries. I didn't mention them there because just in terms of detail. But you can see from the social and environmental side that whilst that gray line shows a high level of disclosure, the actual quality of the data is pretty weak. And that comes out of a study by ISS. And the challenges in measuring sustainability data leads to inconsistent ESG ratings by rankers, which then hinders the accurate investment assessments and leadership's ability to drive sustainability efforts. The availability of the data is increasing, but the lack of breadth and consistency, with only a small percentage of companies producing high scores. So you can see there by those figures there that only 16% are producing high environmental scores and only 18% are producing high social scores. The ISS believes that mandatory reporting and effective enforcement would improve ESG performance, requiring improvements in material sustainability data and metrics being actively managed and scrutinized. And the type of mandatory reporting in the medium term is it's up for debate, but I think some people would say that it is coming to places like South Africa too. PwC reports saying that ESG narratives can't just be focused on values and purpose, that it must be backed by credible data throughout the value chain to manage stakeholders and to react to socioeconomic challenges. And from an ESG raters and rankers perspective, they are racing for high quality data. They are influenced by the investors. They are their customers, and those investors are pushing harder and harder for the raters and rankers to improve their methodologies to ensure that they are digging down deeper into companies and finding far richer and far more accurate and transparent data. So there's a lot of ESG rankers and raters out there, 150 of them. So there is an issue with the kind of expectation of so many different types of raters and rankers. And there is a huge drive from a standards perspective to try and bring a baseline about so that companies can at least know what a baseline looks for in terms of sustainability. But then if you would like to mature, that those various raters and rankers will be pushing you to mature. And that's really what today's session is about, is understanding that baseline and understanding how you can mature and how technology can play a role in that perspective. Many people have seen this type of slide and what's happening at an international level. So let's check the chats while I'm going here, but everything seems okay. In terms of the convergence of standards, we've seen what's happened with IFRS, and we are very privileged to have Dr. Ndidi here from the IFRS Foundation, from the ISSB. And the work that's been happening with the Carbon Disclosure Project, helping form the CDSB, how the SASB, Sustainability Accounting Standards Board, and the Integrated Reporting Framework came together first into the Value Reporting Foundation and then consolidating into the IFRS Foundation. All of that work is really bringing about consolidation of standards. And the huge focus on ISSB side is really on the the financial materiality of sustainability. So it's important that they still collaborate closely with the GRI, which is a lot broader. It focuses on double materiality. And the ISSB and GRI did sign a 2023 Memorandum of Understanding. And so there is work that's going to happen there. At the same time, some people have asked, would there be a merger? Would GRI actually consolidate into it? And this year, the GRI CEO said that it would be impossible, mostly due to the governance hiccup, that it would need a very, very huge amount of work for that to happen. And he doesn't see that happening. Importantly, with the IFRS sustainability standards, is that they've brought in the best practice from integrated reporting, but they've also brought in the CDP as well as the TCFD recommendations into their reporting. And Dr. Ndidi will provide us a little bit more information on that. At the same time, at an international level, you can see on the left the nesting of corporate reporting. You can see the blue box at the bottom is the American SEC. And the lines going out, you've got scope of mandatory disclosure, you've got investor stakeholder spectrum, and you've got the coverage of climate sustainability topics. And you can see that the ISSB is in the middle between the American SEC versus what the EU CSRD is doing, which is double materiality. And EU CSRD has brought in GRI and SASB type thinking into their regulations. So ISSB is a fantastic starting point from a financial materiality, but there is growing expectations towards GRI and double materiality from the EU regulatory side. So there's a lot of work happening to consolidate and also to align between those two forms of materiality too. So the important part is the what next, really. And from Trialogue's perspective, we see a lot of convenient purpose being formed at the top end, and a lot of compliance and reporting driven ESG at the bottom end. And what is missing is in the middle is that leadership mandates, that realignment of incentives, that strategic integration, the selective and material adoption of issues, properly managed processes, coherent and consistent communications, and embedded gains. And so there's a need for an integrated continuum between purpose and ESG sustainability. And what Trialogue has done in partnership with Thompson Harrison, a UK advisory firm, is really developed a framework to look at that and how do you bring that continuum together. And we've developed this framework that looks at purpose and strategic ambition, leadership directive, governance processes and structures, performance metrics, management and assurance, and communication and messaging. And beneath that, we've got 22 sub-principles and 80 rating indicators. And we can use this to really see how a company is performing and how they are putting together all of their processes to understand where the gaps are in terms of their sustainability processes. Too often, companies see ESG as a tick box exercise, when it's actually, in fact, has a lot to do with basic business processes and good business practice. And this framework helps companies understand their processes and how are they integrating the externalities and the impacts of sustainability within their organization. And this is where the real hard work needs to happen. And it's a process with element that has a roadmap and a level of maturity and awareness. And one of the things that companies can do in terms of maturing this process is looking at technology such as Web 3.0 technology, which is why we have brought BanQu to the table today to also share some of their learnings in that space. So Web 3.0, we've heard so much about ChatGPT, but Web 3.0 is bigger than that. We've got blockchain, we've got artificial intelligence, which ChatGPT is part of, and the Internet of Things. And it's so important for companies to be aware of these elements and how they can help ESG. With blockchain, it ensures secure and transparent transactions and data storage. It helps to facilitate decentralized ESG networks and help stakeholders manage and exchange information without the need for intermediaries. AI helps analyze large amounts of data, and it can really help companies identify and prioritize those risks and opportunities. And then Internet of Things, really important on the environmental side to help with efficiencies in energy consumption, water usage, and waste management. So these are really important tools that companies need to take aware of in their process to mature their road to ESG maturity. And my final slide before we move over to the panelists is that the benefits of Web 3.0 for ESG data quality really focuses on data collection, the role it can play with ESG rates and rankers, as well as standard setters, and also the ability to improve integrated thinking. And I think that is the crux of it. Is there are these processes that you need to strengthen, and we shouldn't lose sight of the available technology out there to really help us with this process. I don't want to spend too much time on this slide because I really want to hand over to our panelists to share their thinking. So I'm going to end there. And before we move on to the first poll of the session today, I just want to mention that Dr. Ndidi has invited everyone on this call to a webinar that is taking place in June. And it is basically run by the ISSB, as well as the Financial Reporting Council of Nigeria. And it's a 2-day workshop looking at the first 2 IFRS sustainability standards that are coming out in June and for implementation in next year in January. And it will explore, the webinar series will explore the basic concepts underpinning the SASB standards, which are integrated into the IFRS sustainability standards, and highlights how they were developed to facilitate cost-effective, industry-based disclosure by preparers that yields decision-useful information for investors. And I'm just going to paste the link of that invitation onto our chat here before we continue, so that you may all, I've issued that link, so anyone who is interested may click on that and register for that webinar. All right, if we can just launch the first poll question. So let's see when that poll question comes up. Okay, so if the attendees can please answer the question. What codes and standards do your organizations report in accordance with or plans to adopt in the next 3 years? So you can tick it if you are currently reporting or if you plan to report on this in the next 3 years. I'll give it about 30 seconds and then we'll look at the results. All right, should we look at those results then? Okay, so quite a low amount of attendees have adopted or plan to adopt the codes. 30% on GRI, 16% on SASB, 22% on TCFD, 30% on IFRS, and 30% have no plans to adopt a standard. So that is quite low in South Africa at this point. And having done a lot of integrated reporting in South Africa, there is a low adoption of codes and standards. Most companies in South Africa focus on the integrated reporting framework as their main basis with which they prepare their reports. So there's a huge opportunity to integrate these codes and standards within South Africa. Thank you. All right. So let us move to the panelists. So the first question is for Dr. Ndidi. The ISSB will issue its first 2 standards covering general requirements, IFRS S1, and climate, IFRS S2, at the end of June 2023, with effective implementation in January 24. Dr. Ndidi, what is your key message to attendees on the significant launch? Should organizations prioritize a building block approach and to align to the standards? And what support can organizations get from IFRS? Dr. Ndidi will be presenting a short presentation on her response to this question. Thank you, Dr. Ndidi.
Thank you very much. I don't know if you can see my slides.
We can, yes, we can.
Brilliant. Okay, so I've made this, thank you very much for inviting us to speak here. And thanks very much, Matthew, for the very enlightening presentation you gave ahead. Makes my work a lot easier. I've presented, and I will walk through very briefly, and so I'll pretty much run through them. I'm looking at the time. But I will give these slides to Matthew so that you have an overview essentially of S1 and S2 and what will help you in terms of preparation, and try and give you in very quick terms what the objectives are. And I think the key thing here is we're trying to end the alphabet soup of voluntary initiatives to provide information that's decision useful, cost effective, and market informed. And absolutely, yes, while we are focused on meeting the needs of investors, because that's what our mandate is, what you mentioned, Matthew, about the building block approach is very critical for us because we want to create a common language of sustainability related disclosures. So this is essentially the summary of the building block approach. The advantage we have is that obviously housing the sustainability standards under the roof of the IFRS Foundation, where the accounting standards are housed, what happens is we are trying to create a seamless interconnect so that sustainability and climate related disclosures, which are our first two standards, are essentially building into the financial statements, but at the same time ensuring that we're building a global baseline that is interoperable with other corporate reporting. You talked about GRI, and of course there's also the ESRS, which I know South Africa is very concerned about. In terms of integrated reporting, we have built these into the standards. And so our hope really is that for those, and what we're finding is for those who, we did a study of about 2,000 companies, and we found that South African companies are actually best prepared to adopt S1 and S2, also because they apply integrated thinking. And so that's brilliant news for us. We're really excited about the South African market moving ahead very quickly, and we're working hard to make it as simple as possible. We've also incorporated other standards, TCFD, SASB, CDSB, to ensure that we have a building block approach that will allow the ISSB standards to be interoperable with standards like the GRI, ESRS in Europe, etc. Essentially, I will run through these. You will have all of these slides. This is an overview of what we're working on at the moment. There's a little bit more detail later, but one of the things to flag here is the disclosure taxonomy that we're working on to accompany both the accounting taxonomy, but also the sustainability taxonomy. You'll have an overview here of S1, which is the general requirements for sustainability-related disclosure. Notable here is that there's a one-year relief in the application of S1, but this really focuses on consistency and connections with the financial statements and should be released at the same time as the financial statements. But like I said, there'll be a one-year relief. In terms of materiality, our definition of materiality in the S1 standard, the sustainability standard, is the same as with the accounting standard. So there should be some familiarity here, especially for accountants. We build very strongly on the integrated reporting framework, for example, in terms of our description of sustainability, which again, for those who are very familiar with integrated reporting, offers relief. Strongly also building on TCFD, the 4 pillars: governance, strategy, risk management, and metrics. Again, there should be a lot of familiarity there. We also brought in the SASB standards, which we're internationalizing at the moment, to ensure that they're industry metrics. The way that we see the industry metrics is that they're a proportionality measure. First of all, we're internationalizing them. And secondly, they provide a set of metrics, definitely not complete, but a set of metrics that allow you to begin a financial materiality process according to the industries that you're in. And we've evaluated 68 of those in S2, and there's 77 in total. On climate, focuses on transition planning, climate resilience, and scope 1 to 3 emissions. Again, I've put in quite a few slides on scope 1, 2, 3, including an overview of some of the reliefs that we have in place. Scope 3, we've put in a relief, temporary exemption when first applying S2 that will last for about a year. And we've added significant guidance on scope 3 measurement because we realize that this is going to be challenging. We've also made sure that we have actually created a range so that really companies that are not as familiar can use estimation quite significantly and also less granular data where possible. Also, in terms of the scenario analysis, we've created a guidance on how to do that. And we've taken into cognizance, the need to recognize undue cost and effort, and also to consider the skills, resources, and capabilities that are available to companies. As such, you can see that there are 3 different scenarios for scenario analysis. Those who are just beginning can actually start with qualitative scenario narratives and don't have to go into the greater rigor of more advanced scenario analysis. We have significant application support that will come out with S2. And as mentioned, there's significant also proportionality measures that have been built in to the standard. There are different reliefs that have been provided in terms of comparative reporting, timing of reporting, and in terms of the disclosures. Obviously, the start date we're looking at is an effective start date of 1st January 2024 for those jurisdictions that do disclose, and when to report, and the kind of guidance that we will deliver is also going to come out with a guidance, as well as educational support and capacity building, which we're taking very seriously and we're significantly investing in. Paths towards issuing is, well, at the moment, we're talking about digital tagging. That RFI and exposure draft will come out very soon. We're also talking about agenda priorities going forward, which we've put out on biodiversity, human capital, human rights, and also integration and reporting, which again, for those who apply integrated reporting, we encourage you to really participate. How do you prepare for the standards? It's really the way that you would with other initiatives that you have within the company, your internal systems and your processes, evaluating sustainability related risks and opportunities. What we believe is that S1 and S2 will actually help streamline these and ensure that standards are more comparable. It's really important for us, especially regarding the African continent, is to ensure that we're simplifying that 300 number of standards out there to create one global baseline so that there's more comparability across organizations, across industries. Implement the TCFD recommendations, which you're probably already doing. Take a look at the CDSB framework, which is also part of our body of knowledge. Definitely integrated reporting is going to help regarding S1 and S2. So these are the different elements in the toolkit. Capacity building is major. We've been talking to PAFA, particularly, I know they're housed in South Africa, but they're also Pan-African. We're working very closely with IOSCO to ensure that there's an endorsement of our standards, which should happen shortly after the launch, which incidentally happens in South Africa on the 29th of June as part of the global launches. I've added these slides because we are seeking feedback, and I do want to encourage you to ensure that you are participating. One, we've committed to implementing S1 and S2 and providing capacity building and guidance in that regard. We're also enhancing the SASV standards so that they're more internationally applicable. You'll see an RFI come out on that very, very soon. We're researching targeted enhancements to the standards, which focuses very much on the social, for which input is really important. Connectivity between the IASB and the ISSB, so the accounting and the sustainability standards, is key to what we're doing. Interoperability, working with GRI and also ESRS and other jurisdictional working groups is a core part of what we're working on. Engaging stakeholders, part of what we're doing now, but there are many other activities, including the webinar that was just talked about. This is an overview of our criteria for assessing the new projects, and I'll talk about those very briefly. One is biodiversity, the second is human capital, the third is human rights, and the last is integration and reporting. What we're asking for now is actually, and I really want to encourage you to take a look, I've added the website, provide feedback. It's really important that these standards are written so that your views are taken into cognizance. Otherwise, we will not build a global baseline, and we're very dependent and hopeful about stakeholder feedback. So this is the link to complete the survey, and that's really the end of this presentation. I hope I didn't race through too quickly. You will have the slides subsequently, and I hope that they're useful to you. That's the reason why I presented them. And as Matthew mentioned, we do have a more deep dive webinar on the 6th to the 8th, a total of 6 hours, 2 hours on the 6th, and then 4 different industry segments of an hour each on the 7th and on the 8th. Thank you very much, Matthew.
Amazing how you were able to put so much into 10 minutes, and I think you did it justice in that time. So thank you, and we will distribute that presentation to the attendees. So thank you for that opening presentation. Moving on to Ashish, the CEO and co-founder of BanQu, live from Texas. I think it's now about 4 a.m. So Ashish, the practical application and measuring ESG metrics, many organizations allocate a disproportionate amount of resource resource to data collection and reporting without actually creating meaningful embedded change. But there is a business case for data collection and management for a means of change. How does a blockchain-based software focused on data collection boost productivity and profitability and make supply chains more sustainable?
Great question. First of all, thank you, everybody. Thank you, Matthew. Thank you, Dr. Ndidi and Charles and everybody. Really appreciate it. Look, I think there was a couple of interesting questions in the chat that kind of relate to your question, and it goes back to how do you make it real in terms of value chain, in terms of the data integrity and the efficiency of capturing that information. I just want to take a quick step back, right? Make sure we're all grounded, because Dr. Ndidi really laid out a very concrete framework and what are the data sets required for S1 and S2. I think one of the biggest things that businesses world over sometimes tend to miss is that how do you actually operationalize that in terms of your P&L and your balance sheet? And that's kind of where a technology like blockchain becomes relevant. And I'll use a very concrete example in the South African context itself, right? If you look at a mining operation, or if you look at an operation that is collecting glass or plastic or buying sugar, right? All industries relevant in the South African market. In their supply chains, at the starting point is either a mine or a landfill or a farm location. In all three cases, that farm location or that landfill or that mine is integral to the entire value chain that shows up on the P&L and balance sheet. And you might say, wait a minute, what is this webinar? She's just gone a complete tangent here. Just bear with me for 30 seconds because it's critical, because I'm going to tie to what Dr. Ndidi just said, which is how do you actually then operationalize these reporting guidelines and requirements if your last mile is a location which might have a scope 1, scope 2, or scope 3 implication, right? And this is where data becomes extremely relevant. So if you take that example, at the starting point, you have a last mile location like a mine, and then it's connected to a supply chain, multiple tiers, all the way to the finished good. Companies will report on the P&L of that finished good from a financial accuracy standpoint, but sometimes tend to take ESG in more of a CSR mode, like, oh my God, I have to report on ESG, so I'm going to do something on the side. And I think that's a missed opportunity. The way we look at it is that if you look at your entire supply chain or value chain, if you integrate the ESG data collection effort at each step of your supply chain, then your reporting requirements are not going to be sitting in a silo. So if you go back to the example of a mine or a landfill or a farming location, that's your tier X. As you move up the supply chain all the way to the brand, you're going to find suppliers that are in that supply chain. You're going to find raw materials and finished goods that are going to move in that supply chain. How do you actually collect the data that is going to then tie back into your ESG reporting? So the concrete example would be take the E element and then take the S element. I'm not an expert on G, so my apologies, right? So let's just dive deep into the E and S. If you're at a site that is generating waste, and that waste management is going to have an impact on your carbon strategy, then your reporting needs to collect the data at that particular location in terms of what was the waste, what happened to the waste, and what happened to the communities that were basically either collecting, reusing the waste, or repurposing the waste. This is where blockchain becomes relevant, because now you're going to capture data of that waste in a way that not only you'll have visibility in the last mile, but all the way to the tops. For example, if you're sitting in Johannesburg and you have a mine in Cape Town, you'll be able to log in to a blockchain solution like BanQu or anybody's solution and see actual data that is being captured when it comes to carbon emissions, waste management, and Dr. Ndidi brought up the human rights component, right? Which is if you have mine workers, ASMs, and they do not have good access in terms of human rights, you have to be able to capture that information. So the way we look at ESG reporting is that if you're not at the detail level in your supply chain, capturing that ESG data, ENS data more than G, then when it comes time for reporting, you're going to scramble. And I'll say one last thing, I'll stop with this. Everybody is familiar with what is happening with the Vera scores of carbon credit, right? Right or wrong, it's in the news. A lot of carbon credits were sold and purchased, yet now the information that we're getting is that some of them were false or some of them were fake or whatever. But what's interesting is that they were never tied to a physical location. So if I am purchasing a bunch of trees that are going to allow me to do an offset or a credit that I'm then going to report in terms of my climate disclosures, but I never knew the location, I did not know what happened to the communities, yet I'm selling it as an offset or credit, you're going to be in a lot of trouble, just like what is happening all over the news. So my humble recommendation, if you didn't get anything out of this panel, is go deep, do a risk assessment of your supply chain all the way to the last mile and understand what are the environmental and social impacts of your supply chain. What is the risk and what is the data needed to report on it in order to meet some of the guidelines that Dr. Indiri just said. Let me stop there. Is this making sense?
Thank you. I think it's an excellent introduction and it sets the scene. And I think to demonstrate the type of work you're doing, I'm going to hand over now to Charles Harding. Impact Catalyst, one of the projects they're working on is in partnership with Exaro and with support from BanQu. It's called the Waste Integrated Management Facility Program in the Lephalale local municipality, which promotes ESG development. So Charles, could you tell us about the program and how you're using blockchain technology as part of your ESG metrics approach to empower businesses in the waste value chain?
Yeah, good morning, everyone. Yeah, for some reason, I think the camera is a bit weird today. Yeah, so we are the Impact Catalyst. The Impact Catalyst is a organization that supports socioeconomic development on behalf of our partners. And in this case, it is Exaro. And we are supporting a project where we're looking at rebuilding and almost formalizing the waste economy value chain. I think there's been a lot of discussion around waste and how to improve it in the best way in many cases. So if you look at our country, almost 25% of activities in our economy is in the informal sector. And the more you can formalize the informal sector into formal, it becomes easier to track these activities, but also to support it much better and to grow. Somebody that's not part of the formal sector is not capable of going to a bank, get a loan, or to drive then their business into something a bit bigger. And basically the whole process of the purpose of the project is to look at how do we improve, firstly, moving from informal to formal sector, from the waste management process, and then we need to look at how do we support creating new startups in recycling the waste that is collected from the informal waste, which is now moving to a formal business. So blockchain is actually very important. I think a lot of the discussion around these projects is around how do you collect the data? How do you actually get the data from the source right down through to where the material is actually recycled, and actually looking at a whole value chain of data and how you actually understand from a geographic perspective of how things happen across. Because in many cases, people collect data, but data is not geographically referenced. Geographical data is extremely important, especially in the mining areas, because the mines would like to understand, firstly, what is the state of the communities, because they are part of the ecosystem around the mine. And any intervention that needs to be done needs to be in context of where people live, where the activity takes place, and where the benefit is actually achieved. And to do that, you need to actually have that geospatial data that runs across the whole operation. So, but that being said, is that I think a lot of discussion around ESG and projects like this is around how we actually tick the tick boxes in terms of actually collecting data and then ticking the box to say, well, we conform to the standards. But these projects are actually co-design projects, because if you understand the ecosystem around a mine, you need to understand that the communities, your supply chain, operations and an environment is actually one ecosystem. And the only way to do these things is through some sort of co-design process where your stakeholders are aboard of the process. And that's what basically this project does. It is actually a process where those three elements as part of the ecosystem comes together. And it is co-designed in a way that people are part of the process, people are part of the solutions, and they're part of the benefit. Because without the people that live around a mine, and that actually is going to be left there when the mine closes, in that environment that is left, it is left by the mine. It becomes very tricky if you do not involve people in that process. And so that design process is just as important as collecting the data and understanding how you measure, because the design and the M&E goes hand in hand. So the data allows you to measure, but the design upfront allows you to actually create that theory of change that actually measures where we're going. Thank you.
Thank you so much for that input today, Charles. Before we move on to the next round of questions, I'm going to launch our next poll, which basically asks whether your organization has built a business case and a roadmap to mature your approach to ESG metrics and integrated thinking. So that poll should have come up now. If everyone can please answer, and we will share the results in the next half a minute. I'll let you all take time to answer that question. All right, should we have a look at those results? Okay, so this is good results in terms of where at least 60% are looking at integrating a purpose-led integrated thinking approach with a roadmap. So there's still about just under 50% that are considering it, and a very small amount that are saying that there's no appetite. So from the basis of this poll, it's clear that integrated thinking, a focus on ESG metrics, and having a roadmap is either underway or important. So I think that signals that the work that's happening and that the discussions that we're having here today are certainly relevant and important. All right. So back to Dr. Ndidi. How is technology shaping the landscape of sustainability reporting, and what role will the ISSB play in promoting its effective use?
Well, what the ISSB is doing is building very much on trends already in the market. I think that both Charles and Ashish have spoken about solutions that are in the market that actually help and enable ESG tracking all the way down to the last mile, including the informal sector. What we're doing at the moment is also to ensure comparability and accessibility of data and metrics for investors, which is where our focus is. We're engaging in digital tagging, so we're building the digital taxonomies for the ISSB standards, which will be made available at the same time, so that essentially you have better access to data, better comparability of the metrics that are being used. Just building on the comments of the previous speakers, it's absolutely critical to emphasize how important this data is, especially where there is limited or no data tracking. What that tends to do is it tends to end up having companies rated at the least possible option, because essentially we're looking at sustainability not from the point of view of impact, but actually also in terms of the point of view of creating risks and opportunities for businesses, for better business resilience and economic resilience, obviously, of the overall economy. So technology is key as well in terms of greenhouse gas emissions estimates. You can leverage that also in terms of, building on estimates that help you pull your data together so that even if you're not able to track it directly, which understandably can be hard, especially for smaller entities, estimates allow you to put this into place.
And maybe just a follow-up question for those who don't know, what is digital tagging? Because I think that word gets used a lot, but I'm not sure how many people, attendees, actually know what that really means.
So essentially, it's making financial statements machine readable so that you can actually extract the data and compare more easily across. What we're used to are these physical financial statements, which makes it very arduous to analyze. So it's specifically creating the elements and pulling out so that you can publish your statements, and machines can read them, and it's easier for investors to access data, evaluate data, and come up with assessments.
Okay, thank you very much. I think that certainly helps. Ashish, then could you then provide some specific examples of how blockchain has been integrated into sustainability and ESG initiatives, and what the resulting benefits for organizations have been?
Absolutely. I actually love the digital tagging example. So let's just go down that path. So if on your financial statement, you have reported that you have done a scope 3 reduction at a mining site, or for example, you are using waste material as alternative fuel to reduce your greenhouse gas emissions, and you've reported it on your financial statement. So that's tagged. So when somebody reads it or machine reads it, what we would do, or what we recommend you do, is then that data has to be evidenced or evidence-based to tie back to the reality, right? So for example, if you are at a mining site and you are purchasing, for example, from the local informal waste collections points, say X amount of waste material that converts into biofuel, that reduces your emissions at that mine site, for example, by say 4%. That's a simple example, right? In today's world, there's a massive disconnect between claiming that 4% and the reality of whether that 4% exists or not. So to Dr. Ndidi's point, when the machine reads and you say 4%, yes, somebody will say you did have a 4% reduction. But from an auditing perspective, you are going to need the traceability back to that location where you have to be able to show that X amount of actual waste was collected. So the proof of the asset at the location, which Charles just mentioned, the income that was given to the local communities. So there's a human rights aspect, there's a living income aspect. And what was the conversion ratio of that waste to fuel that then reduced your emissions? So from a blockchain perspective, right, and just for those who are new to blockchain, I'm sure nobody is, but I use a very simple explanation of blockchain, nothing to do with cryptocurrency. So if you're expecting cryptocurrency tips, please jump off the call. The way we look at blockchain is actually pretty simple, right? Which is, if you are on that blockchain system, then everybody in that value chain gets an equal copy of the transaction in a way that it cannot be manipulated or corrupted, which is at the heart of some of the problems we are having with ESG reporting, because it cannot be verified or evidence-based at the point of location, right? So in this example, with the reduction happening at a particular site that is tied to waste management, a blockchain solution will not only verify the waste, the calculation, the location, the people, and it will tie back to the digital tagging. So there's proof of that. I hope that helps. And Dr. Ndidi, please jump in. You're the expert. I'm not an expert on the financial reporting piece. I live in the field, so that's where my expertise is.
No, I think your point is spot on, because obviously what's going to follow is assurance of these sustainability standards. And not just that, it's also the integration of sustainability-related financial disclosures. So as part of the financial statements. And when you look at it from that risk perspective, not just is assurance important, but it's actually also with a view to increasing business resilience and being able to track these factors that could constitute significant risks in the future, but also could constitute significant opportunities, so that there are financial effects of sustainability-related disclosures.
And if I could just add to that, right? I just did a recent risk assessment for an organization, that has a granola bar. That granola bar at the shelf level, like at a Pick and Pay or Woolworths, is going to say that granola bar is carbon neutral. Now that's a big leap of faith, right? And I think that's where the assurance piece is going to come into play, right? So if you look at that granola bar, and if you are selling it at a Woolworth or Pick and Pay to say that this is carbon neutral, then you have to factor in the factory that made the granola bar, the packaging that went into it, and then the cacao that was sourced from Cote d'Ivoire. And that entire supply chain the math has to add up, right? There can't be any manipulation. Otherwise, if you see some of the new EU regulations, which I know are starting to come onto the Africa continent, is that you can't put out a label that says it's carbon neutral and not have the ability to prove it. That's why my humble recommendation to everybody is make sure you do your risk assessment before you decide what E&S metrics that you are going to stand behind.
And Matthew, if I can just add there, the reason why at the end of the slides, I referenced the request for information. We're very aware of the fact that the situation on the African continent in African countries means that we're dealing with a lot more smaller entities and also the last mile. So as this RFI goes out, and it has gone out, and the information request is through July and August, it's really important that you participate, that you look at the survey and that you respond, so that these the social global baselines, actually also reflect the circumstances on the ground and some of the challenges that we might face on the African continent, so that as this baseline is being built, which is supposed to be the global baseline, it takes all of this into cognizance. And Ashish, I would encourage you, especially given some of your insights, to also encourage not just your own company, but also the ecosystem to respond, because this feedback would be very, very valuable.
Absolutely.
Thank you both for that very interesting conversation. And I think I'd like to take it back to an initiative that's on the ground, that's happening. So Charles, in terms of what's happening with your initiative, what has been the response from the team members using blockchain technology? And has there been a noticeable impact for stakeholders and for Exaro, who's the partner on the project?
Yeah, thank you for the question. Yeah, so from our side, I mean, blockchain is very important. I mean, all of us know that digital records is one of those elements that can always be manipulated, and as we previously stated, my colleagues, is that if you really want to make a claim about something, then you need to be able to prove it, and the only way to actually undoubtedly prove that your data is secure and what you are presenting is right is through blockchain technology. Blockchain technology is, as we all know it, very secure. It is a global standard that is best practice in how to secure data, and it allows us then to push the data down from the source right through to reporting to our partners, which is the important part, because obviously it becomes important for our partners to report in terms of their stakeholders, because they're part of a bigger supply chain. So I think that's always something to remember, is that you are always, every company that is, you've got your own supply chain, but you're always sometimes part of a bigger supply chain. And if you start looking at the bigger supply chain perspective, a lot of our minds are getting a lot of pressure from the international communities or their markets to drive a carbon neutral perspective and to prove it undoubtedly that what they're achieving is real. And blockchain is the best way to actually do it, because it allows us to align the data in real time, firstly, because what you can see from the BanQu perspective on a daily basis is exactly what happened every day. So firstly, it allows you to manage a bit better, because if you just take a snapshot to say, well, on a monthly or a yearly basis, to say, well, just from a reporting perspective, it is one view in terms of I check my box in terms of what I wanted to achieve from my sustainability perspective. But it also then becomes a management and a risk management process, because you can actually see what is happening on the ground and how you can adapt on the ground on a daily basis or monthly or weekly basis to achieve more, to tweak the system and tweak the approach. So from that perspective, the adoption and acceptance has been quite high. So we are in early stages of the program, but from our stakeholders' perspective, blockchain is considered the best way of gathering the data and to merge many data fields into one. So we do, for example, have built our own indexes around the communities where we operate, which look at 52 indexes or 52 aspects around a community that we track on a 6 monthly basis. And then, of course, we can then merge data, the blockchain data, in terms of what happened, and we can actually do a correlation between what we see in the 52 parameters on a ward level in the community versus what we actually get from different sources of data like the blockchain. So if you, for example, deploy a program in waste like we're doing, and that creates a significant benefit because now you can see money flowing from through the participants in the entity. Our economic resilience index should show that there's more economic activity, because there is an increase in activity in the rest of the ward in terms of bankability and taxpayers contributing to tax and a few other things. So the whole process is actually part of a bigger ecosystem of data analytics that shows that when you actually deploy the program, the program actually creates its own data that flows through the system that is undisputable in terms of the technology, but it also it is correlated with the secondary sets of data that actually shows what's actually happening on the ground as well of participants that's not part of the program. Because we need to also understand in our country is that for every one person that's getting a salary, say supporting 6 other people. And it's very difficult tracking the other six people if you don't create larger indexes or metrics to actually measure what's happening in the community on top of the one person you're tracking as part of the salary that they're actually getting. So that's basically why we're doing it, and that's why the acceptance is there, because everybody needs the data, whether you are going to a community engagement, because when you go to community engagement, the first thing a community leader will ask you to say, well, what is the benefit that we are getting out of this? And without any data, it's always hollow promises. If you can't go to a community leader and say, well, we've done this before, this is exactly what you're going to get. You go to the municipality and say, well, this is how we're going to benefit you, and this is how we're going to track and do the M&E. And you go to the corporates and the supply chains and say, well, this is how we're going to do it, and this is how we're going to measure the progress of this. It's all of this becomes empty promises. And M&E as part of the data, whole data design or the architectural design is really going to drive how you actually get buy-in. Because if you're just driving data for the sake of data and you don't use it to actually create the buy-in that is required to achieve what you need to achieve, it becomes a very tricky space, because in our space that we work, there's a big mistrust between communities, environmentalists, and the mines itself. And the only way to create or diffuse the mistrust is firstly by putting everybody on the same page in terms of what we want to achieve, that bigger vision to say, this is where we're going. This is how we're going to measure if we are going to achieve it. And we're going to use the following data metrics to actually achieve that. And then over time, show that you're actually achieving those milestones as was promised or agreed, because if one stakeholder jumps off the ship, the whole program falls apart. And this is, I think, why everybody's happy with the approach, the data-driven approach that we're taking, because it creates that transparency that everybody can see, and creates then that trusted relationship or trusted space where the stakeholders can actually work together to achieve what we want to do as a collective.
Thank you, Charles. I think that the point on transparency and trust is so important in the direction we're moving in. And it speaks to a question from one of the attendees, Gwen Foster, who asks, how will monitoring systems detect fake news in a world of AI? So I'll open that question up to anyone on the panel who'd like to answer that.
I can take that. Look, I think just that's a great question, right? Honestly, the blockchain is not the end all, right? And I think the point of fake news is a good one, but I'll use an example to address that question, right? And one from South Africa, one from Zambia. I'll make it very quick, right? So 5 years ago, in 2018, we started a rollout in the mining belt on the Zambia-Congo border for cassava farmers, massive informal sector of small farmers, right? And extreme poverty zones. And this you can verify, you can look it up. There's a lot of public data on this available. And what we have done over the last 5 years, we've connected thousands of smallholder farmers to Zambia breweries so that they now have a traceable, transparent system that they can use through an SMS phone that allows them to sell their cassava, do regenerative agriculture practices, and sell it all the way up to Zambia breweries. Now, how is this related to fake news? I'll get into that in a second here. What the transparency allows them to do over the last 5 years is to make sure that the pricing information, the quality information is accurately delivered to the smallholder farmer on an SMS phone that is using mobile money like M-Pesa. And how you basically break the barriers around fake news or misinformation is to create this level of transparency, right? So every farmer at any given time knows what's the price of cassava, knows what's the quality parameters, right? You can't really fake that. On the same token, in the last 3 years, and this I can share, we're working with EPR, Extended Producer Responsibility organizations in South Africa, for glass and PET and paper and aluminum, where the informal waste picker, right, is now empowered through an SMS phone to know how much PET they're selling, at what price, what is the incentive, right? And if you create that traceability and transparency in a way that you cannot game the system, this is how you would tackle AI fake news. I will say this though, right? We don't get into kind of the news aspect of it at all. So if they're getting fake news from some other channel, that's theirs. But what I'm trying to focus on is, in this conversation, the ENS element is directly tied to the information that needs to be delivered to the informal sector, which actually, in my humble opinion, and Dr. Ndidi, correct me if I'm wrong, at least represent 50% of the trade that is going to be tied to ESG. It might be more, but that's my guess.
So there's a significant number, obviously. Generally, if you talk about scope 1, 2, 3 emissions, in some companies, scope 3 emissions are approximately 70% of your emissions. So there's no doubt that technology will certainly help and is needed. I saw a question in the chat as well saying I'm not responding to this question because we're in the informal sector. And that's where, tracing all the way down to the value chain becomes very interesting, because the larger companies then will deploy this technology that makes it easier for the informal sector to be embedded in reporting, so that the tracing and following the value chain and being accountable for the entire value chain is something that's absolutely critical. And from the African perspective in particular, it's actually really important to explore ways to leverage technology or data estimates, particularly because assurance is going to be key, but also in terms of being able to get a whole and holistic picture of the elements and the risks and the opportunities that impact, especially those larger corporations that have to attract sizable amounts of capital and comply with these sustainability disclosure requirements.
Okay, then on to the next question, which you're referring to there. One of the attendees, Neville, asked about the business case that benefits communities, or how relevant communities are with the business case being considered. And I'll open that question up to anyone on the panel who would like to answer.
It goes to income, right? At the end of the day, if you are an informal waste picker in Johannesburg, and you've been picking plastic paper for the last 5-10 years, you're completely invisible. Yet the brand is claiming a circularity score, or it's claiming their EPR score, or whatever ESG score, right? So the business case is twofold, one commercial and one social. The business case for the brand is that if you use this data-driven transparency approach for your ESG reporting, not only will you actually have better visibility in the inventory at your mine level, at your landfill level, or at your farm level, which is commercial win, but that smallholder farmer or that informal waste picker now is visible in the supply chain, so they can start building this data that allows them to be bankable, that allows them to prove their existence. So you have an ecosystem that begins to thrive, right? So the business case is very straightforward. If you take this data-driven approach, you're going to reduce the cost of your supply chain. You're going to reduce the fraud and disconnects in your supply chain, which means you'll be able to have a much more efficient P&L. Plus, you're going to be able to tell your consumer, like, we do this in Ecuador, where the actual beer bottle has a QR code, and the consumer knows who the farmer is, right? It's not this aggregated data saying we're helping farmers. You can go talk to the farmers and look at their SMS phone deposit. So it's a big marketing play. And the farmer or the waste picker now is part of the digital economy. So they're bankable. They're not informal.
Yeah, if I can add a bit to that, that is that I do believe it is not a easy answer, or not a one size fits all, because it depends on the complexity of the project. So if it is a project that enables individuals, in some cases, I mean that is not as complex as, for example, on some of the sites, for example, where there is large scale solar voltaics being deployed to actually reduce the carbon footprint of a mine. Those are big businesses and much more complex, where the community is really asking the questions about the ownership structures of these installations or businesses. I was a keynote speaker 2 weeks ago at one of the Just Energy Transition conferences, and one of the big things that came out of those conferences, that the community representatives stood up and said, but what you're doing here, we're gonna stop everything. We're gonna burn what you're doing now, because you haven't spoken to us about the ownership and how we participate in these businesses in the future. And these are a lot more complicated businesses. Running a R1 billion PV photovoltaic plant, and the ownership structures around that is a lot different than, for example, individual getting benefit from a project. We're also doing, for example, projects where we're doing agriculture on mine land, and those are the same process, because the ownership structures of those activities, because it is much bigger businesses, we have to go through a lot of work to actually engage with communities. On one of the farms that we're doing in Limpopo, we just went through a process where we engaged with 1,500 community members to just get buy-in on the business plan. And because we need to understand that our partners like Exaro, if the community actually gets upset about the way that we do a project and they start burning tires in front of the gate, that costs Exaro tens of millions of rands a day because of that disruption by the community. So the community process and the buy-in, and to make sure that also from a sustainability perspective, the S part, in terms of what happens to the community in the future, because if the mine closures, those communities are left there alone. You must actually transition the economy in such a way that they are independent of what happens to the future shocks in the economic structure. So, and to make sure that they are future or resilient in the future shock, and that you actually transform the economic structure to create more resilience, they must be part of the solution space. And so from my perspective, that is extremely important. And sometimes it takes a bit longer but it takes you a lot longer if they pull you back and reverse your process right from the start. So that process is very important.
I think what you've said there speaks so much, to what we do with our integrated thinking framework and the processes that we look at. Because at the end of the day, the collection of ESG data is one element of it, and it needs to mature. But the various processes, such as stakeholder engagement, such as the risk assessment process that you're talking about, Ashish, those are all these processes that are not being focused on when it comes to sustainability often. People are focusing too much on the data points. And in today's discussion, we want to really drive that home, that it's both the process and the data and how you use technology, but don't forget about the process. And I'm just going to move back to Dr. Ndidi, because I know I cut you off there. So if you just want to add or respond to that there.
No, Matthew, you said exactly what I was going to say. I mean, the reason why we're so pleased to be working with the integrated reporting framework as well, and part of what we have done in terms of defining sustainability or describing sustainability with reference to the resources and relationships and the value creation process, as one of the things with integrated thinking is that you're getting the whole organization behind sustainability risks and opportunities. You're considering how all of these resources and relationships help to build social license to operate, which is so absolutely critical and impacts directly on or is drawn directly from communities and helps to build exactly that business case. So you no longer have, at least the way that we see it, a siloed sustainability function within an organization, but rather you have the chief risk officer, you have the chief financial officer, you have the chief operations officer, essentially concerned with, environmental and social risks and how they impact the financial performance of the company and how they ensure that the relationships and resources are maintained in order to create value as opposed to preserve or erode value over time. And all of this is actually increasingly important to investors because if you don't take this into cognizance, then ultimately you're actually damaging your business in the long term. So we're moving into an era where sustainability is mainstreamed and it's looked at from a risk and opportunity point of view and will be embedded in financial statements and financial disclosures going forward.
Dr. Ndidi, I'm going to keep it on you here. So we've drilled down into blockchain and into right to the bottom of the pyramid, which is something that you're very a leader in. But when you drill back to the IFRS level and to looking at how companies can use a standard like IFRS to actually go on a journey of maturing sustainability within their organization, what role does data and measurement play in that journey? And how can organizations effectively collect, analyze, and report the data to drive their progress at a holistic level?
Okay, so first of all, the reason why, so obviously the IFRS standards build on several standards that you're already familiar with. One of them is the accounting standards. So if the IFRS accounting standards, where, for example, our definition of materiality aligns with that. And we're working very closely and borrowing a lot from the accounting standards so that there is connectivity between the sustainability related disclosures and your financial statements. And you will find that all through the documents which you will have in your hands at the end of June. So you can deep dive not just into the standards, but also into the guidance that's associated with that and the basis for conclusions as well. That should hopefully be very useful. Integrated thinking is absolutely key. So again, for South Africa that is familiar with this, what we're doing is we're building on that, and that should hopefully give you also a very good foundation with which to embrace S1 and S2 and get the entire organization behind sustainability related disclosures, as we've discussed extensively today, especially because there's a very strong business case for this. TCFD, some of you might be familiar with the framework, and even if you're not, there are 4 key pillars. One of them is governance. So actually, how do you ensure that the board has oversight over the metrics and the targets that you set, which is also one of the pillars? How do you make sure that it's embedded in your strategy, these sustainability related risks and opportunities? And also, how do you ensure that you're evaluating the risks and opportunities thoroughly in line with that strategy towards your financial disclosures? What's also really important is to bear in mind that we have the building block approach, where obviously you're starting with your financial statements, but you're wrapping into those your sustainability related disclosures. And beyond the S1, obviously we've started with climate, but it goes beyond climate because we've got the RFI out at the moment to ask really and consult on what should we be doing next. Should we be focused on biodiversity and nature capital? Should we be focused on human capital, including diversity, equity, and inclusion? Should we be focused on human rights? And of course, the 4th question is integration and reporting, which is very linked to the integrated reporting framework. And that's the reason why it's so critical that you respond to that. In terms of how important is data, absolutely crucial. But then it's not the be all and end all. As mentioned earlier, we have various proportionality measures that actually allows you to, based on your capabilities and the resources available to you, based on the size of your organization, to start from qualitative assessments and work your way towards more quantitative assessments. And so when you look at the guidance, you'll realize that there are methods whereby, depending on where you are in terms of your preparedness, you can still report. And the idea is that you get better over time. And as you get better, you're actually building better business prospects. And above all, you're providing that data and that information that investors require and are asking for. And that's what we are responding to. Capital markets and investors are asking for sustainability related disclosures that are comparable, that are decision useful, and can be used to essentially channel capital flows. And so this is the reason why this is absolutely essential, especially for the African continent.
Thank you, Dr. Ndidi. And I think what you said there in terms of the size of an organization, there are huge costs involved. And I think a question for Ashish then is, what are the potential cost and resource implications for organizations when adopting blockchain solutions for sustainability and ESG metrics, and how can they be justified?
Great question. I think honestly, the cost of not implementing a solution, forget blockchain, right, is much higher. So just on the example around biodiversity, right? If you're in the mining sector in Africa, and I know South African mining companies are starting to look at this, is the alien species removal, right? So for those of you who don't know, there's a lot of biodiversity impact when a mine kind of comes to its end of life. And those alien species, which are plants, need to be taken out to restore the soil health. And I think if you look at that very specific example, and other parts of the world are starting to do that, you are going to have to, on your TCFD, report your biodiversity actions in terms of right to mine. How is the alien species removal happening? Are the local communities being empowered? And eventually, are you making a green charcoal out of it, right? You look at all of that, and if you wanted to implement a technology solution, it's going to be nothing, right? In terms of the cost versus the cost of a fine that you would pay, because if you left the alien species there and you had a massive problem from a climate perspective, right? So typically what I tell people is that if you're thinking about ESG as a separate bucket, then your cost of implementation is going to be extremely outrageous because you're thinking it in the wrong way. If you think about implementing a technology solution, like in this case, alien species removal, biodiversity restoration, and then reporting on your financial disclosure, then it's going to be part of your supply chain budget, right? And typically what we find that it's between 1% and 5% of your current supply chain budget. If you devote that towards a technology solution that goes all the way to the last mile, the ROI typically is 3x within the first year, right? So just to make sure everybody's on the same page, it's 1% to 5% of the cost of your supply chain for a certain line. So if you're operating a supply chain from point A to point B, and that has an alien species removal, you're going to spend about 1% to 5% of that if you really want a technology solution that gives you the reporting capability, and the ROI will be 3x to that investment.
Well, it seems like a good business case then. Thank you, Ashish. A question I had for Dr. Ndidi again, just in terms of the IFRS sustainability standards, what is the likelihood of it being adopted in South Africa as a voluntary code or as a compulsory code? Do you have any insights on that for South African audience members here?
So, I mean, voluntary adoption is something that we are recommending. We're developing the global baseline because we think it is useful. We're developing it because investors have demanded it. And the term truly global baseline is exactly what we are focused on to ensure that we're reducing the alphabet soup of sustainability standards and creating a standard that really all can use, large companies, small companies, in all jurisdictions and countries globally. The regulatory adoption varies from country to country. Obviously, the standards are not out yet. They're not out till the end of June. So there are very few countries that have decided ahead of time to adopt. One of those is Nigeria, where you were invited to the workshop. And the reason why Nigeria decided to adopt ahead of time and actually to change their legislation to allow for the entity, the Financial Reporting Council of Nigeria, that oversees accounting standards, to also oversee the IFRS sustainability standards, is because there the thinking was that this is going to reduce the cost of reporting and also the burden of reporting, and will also allow for more seamless integration across the country and across the companies. As you can see from the workshop, the FRCN is working very closely with the exchange in Nigeria. And the thinking there was, because this is really much more challenging for many African companies and countries, it's very important to be ahead of time. We also have a few companies, actually also South African companies, that have indicated that they are interested in voluntarily adopting because they see the logic in this. I think what's going to happen in South Africa is that once the standards are out, then that decision at a policy level will be taken in terms of who exactly is going to be overseeing the standards and exactly how you proceed. But I don't think that will happen before the standards are released. Having said that, we are launching the standards in South Africa on June the 29th. It will be hosted at the JSE, and it's a forum that will be sponsored by SAICA. And we're very, very engaged and actually also very grateful for the feedback that we had on the consultations, on the exposure drafts of S1 and S2. There's been a lot of feedback from the South African market into the standards. And as you know, we also work very closely with the integrated reporting framework. a lot of the concept of integrated reporting and integrated thinking have been built into the standards. So I'm very hopeful. We are very hopeful that what you will find as South African reporters, is that this standard is useful. It will help you standardize and simplify your reporting. And it will actually also end up, also because we're working very closely in terms of interoperability with European and other global standards, you will find that adopting this global baseline, whether on a voluntary or a mandatory basis, is actually something that eases that burden of reporting and is built in such a manner that you will be able to adopt and implement and actually improve business resilience as a result of these disclosures.
Thank you, Dr. Ndidi. Our final poll question. Based on the discussions today, would you recommend Web 3.0 technologies like blockchain for your organization to both mature the management of your ESG metrics and issues, as well as delivering tangible financial and non-financial benefits and impacts? It's a single choice, yes or no. And then I'll hand over to Ashish. Once you've got the final poll responses, I'll hand over to Ashish to do closing. I think there might be load shedding in Joburg at 12 o'clock. So if I drop off for any reason, the webinar does end at 12. So yes, I hope I don't, but I just want to warn you. Okay, hopefully everyone has answered that question. Would you recommend blockchain, AI, Internet of Things for your organization to mature your metrics and issues? Let's see those answers. I think the poll has disappeared. There we go. So 85% of the attendees today would recommend blockchain or Web 3.0. That's fantastic. All right, Ashish, on that note, I'll hand over to you to close the session. Thank you once again to all the panelists.
Thank you so much, everybody, Charles and Matthew and Dr. Ndidi, everybody, extreme gratitude. One quick thing I'll leave everybody with, right? It's technology is not the answer, right? It is an enabler. You've heard that sentence many, many times. In this context, in my humble recommendation, you want to rethink how your supply chains have been operating, because that is at the heart of the issue, right? And the simplest example is if you are a retailer and you're putting out a product, there's a good chance you know tier 1 and tier 2, but you're completely blind after tier 2 all the way to the last mile. So if you truly believe in ESG and everything that Dr. Ndidi has said in terms of the framework and the sustainability component that Charles mentioned, take the time to think past your tier 2, because that is where your blind spot is. That is where poverty exists. That's where your environmental and social gaps are. And if you don't do that risk assessment all the way, none of this would have been of help to anybody. So I'll end with that.
All right. Well, thank you very much to everyone for attending. I really appreciate it from Trialogue's perspective. Thank you.
Thanks,
everybody. Have a good day. Take care. Bye.
Cheers. Thank you, Doctor.